A bed of Chipotle lime rice, topped with hearty scoops of grilled chicken, pico de gallo, corn, lettuce, and that quintessential scoop of sour cream, the Chipotle burrito bowl. The only thing more enticing than this hearty package of fresh Mexican food is the business behind it. Hello. Hello, YIS judges. My name is Carl Liu, and I'm currently a senior at Eleanor Roosevelt High School in New York City. And today, I'll be presenting Chipotle Mexican Grill, the ubiquitous Mexican quick service chain whose restaurants can be found across North America, 57 of which right here in New York. Now, Chipotle doesn't just offer high-value meals. They offer an experience, both digital and physical, that leaves the customer wanting more. This fact, in addition to raw business growth and strong business fundamentals, lead me to describe Chipotle as today's preeminent value investment. However, before we jump into financials, what even is Chipotle? Well, Chipotle is a Delaware-based Mexican quick service chain principally operating in North America, although they do also operate locations in France, Germany, and the UK. Chipotle's fleet of 3,300 locations serve a relevant menu of burritos, burrito bowls, quesadillas, salads, as well as addition to a variety of high-margin add-on sides like guacamole and queso. Chipotle's CEO and CFAO both have multi-decade-long tenures in the consumer staples and the restaurant sectors, which is perfect for competing in the fierce quick service industry. Chipotle's revenue has grown at a compound annual growth rate of 15% across the last 5 years. Currently, the stock trades just under $3,000, but under my buy recommendation, I believe that they can reach a 19% upside of roughly $3,500. However, revenue is just the surface. Digging a little bit deeper, we see that Chipotle's revenue is simply a function of the number of restaurants that they operate multiplied by the average revenue that they generate per restaurant. And looking to the right, we see that both Chipotle's restaurant count and same-store sales growth have grown at a 6.5% and 8% compound annual growth rate, respectively. So they're clearly leaning in on these two levers to grow their revenue. Also notable is a 27% restaurant level margin, meaning that Chipotle's investment opportunity, in other words, construction, is good and that they should continue to plow the residual cash flow into construction. Currently, Chipotle operates 3,300 restaurants, but management believes they could open up to 7,000 in just the US alone. And at the current pace of roughly 300 restaurants per year, that's a decade-long runway for attractive growth and the opportunity to invest capital internally at attractive return. However, analyzing Chipotle even deeper, we see Chipotle's comparable crushing unit economics in full scope. Each Chipotle restaurant generates roughly $3 million in sales every year and costs roughly $1.5 million to construct. Something that's important to know is that the restaurant level margin is at 27%, which is notably higher than the industry average and the close comparables like Shake Shack, Cava, Sweetgreen, and Wendy's. Also important to see is that the restaurant level sales to construction cost ratio is also higher than the comparables, meaning that Chipotle's restaurants as an investment for Chipotle is much better than their comparable peers. Now, strong unit economics allow Chipotle to boast a wider moat, remain more resilient in the face of market cycles. And they also enable Chipotle to serve the fresh food, high quality food, without becoming uncompetitive on the basis of price. Speaking of shareholder value creation, a DuPont analysis on Chipotle reveals that their growth and return on equity has been attributed to raw improvements in business efficiency and cost management. Return on equity as a metric can be factored out into three numbers: the net profit margin multiplied by the financial leverage ratio multiplied by the asset turnover. And if we analyze the past 5 years, we see that Chipotle's increase in return on equity has been primarily driven by increases in net profit margin and their asset turnover, meaning that they've been just able to create more value from their assets and manage costs effectively, which shows clean raw business growth. However, even though Chipotle has grown their return on equity from 25% to 45% in the last 5 years, they still have room to improve. Their asset turnover ratio has yet to recover from pre-pandemic levels. And they can also continue to increase the net profit margin by driving price hikes across their menu. However, instead of talking about Chipotle as a business individually, what are some of the tailwinds that they're benefiting from? Well, first of all, consumers are shifting to value. According to McKinsey, 2023, roughly half of all consumers in the US are taking a wait and see stance when it comes to restaurant spending, which means that consumers are naturally just searching for more value in their discretionary purchases. However, I believe that Chipotle is one of the few restaurants that can actually nudge consumers out of the spending pattern due to their strong brand reputation and reputation for value. In addition, Chipotle has become post-workout staple. Roughly 80% of all gym goers are millennials, and the average Chipotle customer is a millennial. Gym goers are 2 times more likely to go to Chipotle after a workout, according to the New York Post. So Chipotle is going to continue to capture this this secular consumer shift of increasing focus on health. Analyzing Chipotle with a Porter's 5 Forces analysis, although Chipotle does face a lot of competition from restaurants with very similar restaurant formats like Sweetgreen and Cava, Chipotle is still able to stand out from the pack because of the fact that they dominate the Mexican food vertical specifically, and they have just stronger unit economics in general. However, let's jump into some of the risk factors that Chipotle faces. First of all, they rely on digital sales. Roughly 37% of all of Chipotle's revenue are derived digitally, whether that be through the Chipotle app or their website or through a third-party delivery service. But they're continuing. But one of the mitigants that Chipotle is implementing is light menu price increases, and they're also investing more into Chipotle format. So a drive-through Chipotle where it's strictly digital orders. That's going to help them manage like digital throughput and revenue. In terms of the business level, Chipotle faces limited supply diversity, especially for certain core ingredients like corn and adobo, but they've made pushes to increase their supply diversity over the last few years. Another big industry headwind that they're facing are federal increases in the minimum wage for quick service restaurant workers. For example, in California, I believe they're raising it from 16 to 20. However, given Chipotle's strong unit economics, I believe that they're still able to remain ahead of the competitors, given that considering all else equal. In terms of valuation, Chipotle is trading at a multiple of 70, which is much higher than their industry average of 25. However, I think that this valuation is justified given their runway for growth, their decade-long runway for growth, and their consistent return on equity. However, in addition to strong unit economics, Chipotle is also investing heavily into AI. For example, their first innovation, which is an AI-powered kitchen assistant, Chippy, produces tortilla chips, but uses AI to incorporate the human element into production. So maintaining that extra salty, extra limey chip in your bag. Another way that Chipotle is using AI is through their kitchen management systems. For example, they're using an application called Press to Taste, in which they use AI to implement demand-based cooking and demand forecasting in their restaurants so that they can increase food freshness and minimize waste in their restaurants. In terms of ESG, Chipotle has undergone significant scrutiny over the last few years due to multiple cases of foodborne illness. However, Chipotle, in response, has implemented a food safety council in which they implement greater food safety protocols and new technology to keep food fresher in the restaurants. They've also implemented a multi-year effort called Food with Integrity, in which they're committed to sourcing food that improves sustainability and overall animal welfare. They're also leveraging a diverse workforce. Seen in the pie chart, the male and female workers in Chipotle represents a roughly 50-50 split. The employee base is diversified both racially and ethnically. And they also promote in-house development career opportunities within the last 3 years. And I think these two factors combined, being the commitment to fresh, clean food that improves sustainability and implementing diversity throughout their organization, is going to help them, attract what is today's increasingly conscious consumer base. However, the question still remains: is Chipotle at its current price a good stock to buy? Well, after doing a DCF analysis and running sensitivity analysis, the answer that we get is a yes. More specifically, we're looking at the price target of roughly $3,500, and that reflects fulfilled restaurant goals, the decade-long runway to deploy capital, their great unit economics, and the favorable industry tailwinds, and the preferable consumer preference shifts that are working in their favor. Thank you so much, judges, for your time. I'd love to answer some questions.